Hey everyone, and welcome back to the channel. Today, we're re-diving into a fascinating topic that might mean two completely different things depending on who you ask. The bonus ladder. We'll explore both versions, one a powerful investment strategy and the other a feature you might see in your favorite apps. Let's break down how you can use both to your advantage. First up, let's talk about the financial world's version, the bond or CD ladder. If you're looking for a way to generate steady, predictable income while managing risk, this is a strategy you need to know. It's brilliant in its simplicity. Imagine you have a lump sum of money to invest, say $10,000. Instead of putting it all into one single bond or certificate of deposit or CD, you'd split it up. This is what's called building the rungs of your ladder. For example, you could take that $10,000 and divide it into 5 equal parts of $2,000 each. You'd then buy 5 different CDs. The first one matures in 1 year, the second in 2 years, the third in 3, and so on, all the way up to 5 years. This staggering of maturity dates is the core of the strategy. So, why do this? It accomplishes a few key things. First, it creates a regular cash flow. Starting next year, when your first 1-year CD matures, you'll get your $2,000 back, plus in the year after that, the 2-year CD matures, and you get another payout. This happens every single year, giving you predictable access to your cash without having to sell anything early. But here's the really clever part. When that first CD matures, you don't just spend the principal. You take that $2,000 and reinvest it into a new 5-year CD. Why 5 years? Because that's the longest rung on your ladder. And longer-term investments typically offer higher interest rates. The next year, when your original 2-year CD matures, you do the same thing. Reinvest it into another 5-year CD. By doing this, you're constantly refreshing your ladder. After a few years, you'll have a portfolio where one of your investments matures every single year, and you're always reinvesting at the longest term, highest yield rate available within your ladder's structure. This brings us to the biggest benefit: mitigating interest rate risk. This is a huge deal. If you lock all your money into a single 5-year bond and interest rates suddenly shoot up, you're stuck earning a lower rate for years. You've missed out, but with a ladder, you're protected. If rates go up, great. The portion of your money that's maturing that year can be reinvested at the new higher rate. You get to take advantage of the better returns. On the flip side, what if interest rates fall? You're still in a good position. Only a small portion of your money is maturing and needs to be reinvested at the new lower rate. The rest of your ladder is still locked in at the older, higher rates you've secured in previous years. It has a fantastic way to smooth out the bumps and avoid the stress of trying to perfectly time the market. A ladder also strikes a beautiful balance between yield and liquidity. Longer-term bonds generally pay more, but your money is tied up. Shorter-term bonds are more liquid, but pay less. The ladder gives you the best of both worlds. You get the higher yields from your longer-term rungs, but you also have the liquidity of a rung maturing every single year, giving you access to cash if you need it. One quick but very important tip: when you're building a bond ladder, try to avoid callable bonds. A callable bond is one that the issuer can redeem or pay back before its maturity date. This can completely mess up your strategy. Imagine you have a high-yield bond as a key part of your ladder, and the issuer decides to call it back early because interest rates have dropped. Suddenly, your expected income stream is disrupted, and you're forced to reinvest that money at a less favorable time. Stick to non-callable securities to ensure your ladder remains stable and predictable. Okay, so that's the investment ladder. Now, let us switch gears completely and talk about the bonus ladder you might encounter in the world of gaming and apps. This is a totally different beast. Here, a bonus ladder is usually a feature where you're given a reward and then offered a chance to risk it for an even bigger prize. It's often a double or nothing kind of deal. You can climb the ladder, doubling your winnings at each step, but if you lose a single round, you often walk away with nothing. So, how do you make money, or more accurately, maximize your rewards in this scenario? The key is to think like a strategist, not just a gambler. First, you need to understand the probabilities. These games are designed to have the odds shift against you as you climb higher. The first step might offer a 90% chance of success. The second, maybe 80%. By the time you're aiming for the top prize, your chance of winning could be 50% or even lower. The game is tempting you with a big payout, but the risk is increasing exponentially. The most important skill here is assessing risk versus reward. Before you even start climbing, you need to decide what a good enough win looks like for you. Set a clear limit. Maybe you decide that you'll stop and cash out once you VA successfully doubled your initial reward 3 times. Stick to that plan. The temptation to go for just one more is incredibly strong, but it's also the fastest way to lose everything. A disciplined approach is far more profitable in the long run. Consistency beats chasing huge, unlikely win. Think about it. Would you rather secure a small, guaranteed bonus every single day, or risk it all every day for a massive jackpot that you'll probably never hit? Over the course of a month, the person who consistently cashes out with smaller, safer wins will almost always end up with more rewards than the person who constantly goes bust chasing the top prize. So, for the gaming bonus ladder, the strategy is to know the odds, set a firm cash out point, and value consistent gains over risky all or nothing plays. Don't let greed cloud your judgment. Claim your earnings and live to play another day. There you have it, 2 very different concepts, both called a bonus ladder. One is a disciplined, long-term investment strategy for building wealth and stable income. The other is a short-term game of risk management and probability. Whether you're building your financial future or just trying to maximize rewards in an app, the underlying principles of understanding the rules, managing risk, and staying disciplined are what will lead you to success. I hope this breakdown was helpful and cleared up any confusion. If you enjoyed this video and learned something new, please give it a thumbs up and consider subscribing for more content. Let me know in the comments if you've ever used a bond ladder or if you have your own strategy for gaming ladders. Thanks for watching, and I'll see you in the next one.
Hey everyone, and welcome back to the channel. Today, we're diving deep into one of my favorite topics, how to build a serious income stream with dividend stocks. A lot of people think it's just about picking the stocks with the highest numbers, but there's so much more to it. If you want to build a reliable, growing source of passive income, you need a smarter strategy. So grab a coffee, get comfortable, and let's talk about how to make your money work for you the right way. First up, and this is a big one, don't just chase the highest dividend yields. I know it's tempting. You see a stock offering an 8% or 9% yield and think, wow, that's a huge return. But hold on a second. A super high yield can often be a red flag. It might mean the stock's price has plummeted because the company is in trouble, and the market thinks that dividend is about to get cut. Think about it. Yield is calculated by dividing the annual dividend by the stock price. If the price drops dramatically, the yield shoots up, but it doesn't mean the company is healthy. In fact, what's been happening recently is that a lot of investors have been piling into these high-yield stocks, which paradoxically pushes their prices up and makes them more expensive than they should be. You could end up overpaying for a risky asset. A company paying a monster dividend might not have enough cash left over to reinvest in its business, which is crucial for long-term growth. So instead of just looking at the yield percentage, ask yourself, is this dividend sustainable? Is the company financially sound? A lower but safer yield from a strong company is almost always a better bet than a flashy, high-risk one. This brings me to my second and arguably most important point. Focus on steady dividend growers. These are the real superstars of dividend investing. I'm talking about companies that have a long, proven history of not just paying a dividend, but increasing it every single year. We call these companies dividend aristocrats or dividend kings. They've weathered recessions, market crashes, and all sorts of economic turmoil, and they still manage to give their shareholders a raise. Why is this so powerful? Let's say you invest in a company with a modest 3% yield. But that company increases its dividend by 10% each year. Over time, your personal yield on your initial investment, what we call yield on cost, will grow exponentially. That initial 3% could become 5%, then 8%, and beyond, all without you investing another penny. This is the magic of compounding in action. These companies are usually stable, mature businesses with strong cash flows and a management team that is committed to rewarding shareholders. They signal confidence in their future earnings by consistently raising their payouts. This strategy isn't about getting rich quick. It's about building reliable, growing, long-term wealth. It's a marathon, not a sprint. Now, let's talk about a more opportunistic strategy, investing in companies that are restoring their payouts. During tough economic times like a recession or a major industry downturn, even good companies might have to temporarily cut or suspend their dividends to preserve cash. It's a prudent move to ensure the business survives. A lot of investors panic and sell off these stocks, causing their prices to drop. But this is where the savvy investor sees an opportunity. Once the economy starts to recover and the company gets back on its feet, one of the first things a healthy business will do is reinstate its dividend. This is a huge signal of strength and confidence to the market. If you were brave enough to buy shares when the price was low and the dividend was suspended, you stand to benefit in two ways. First, you get to lock in a very low-cost basis. Second, when they bring the dividend back, your yield on that low cost can be fantastic. Plus, the stock price often rallies on the news of a reinstated dividend. It takes a bit of research and courage to identify solid companies that are just going through a temporary rough patch, but the potential rewards can be significant. You're essentially betting on a comeback story. Another exciting area to look for opportunities is with first-time dividend payers. These are often companies that have moved from a high-growth phase into a more mature, profitable stage. Think about a successful tech company that has spent years reinvesting every dollar back into growth. At some point, they become so profitable that they start generating more cash than they can reasonably reinvest. What do they do with that excess cash? They start returning it to shareholders in the form of a dividend. Initiating a dividend is a major milestone for a company. It signals a new level of financial maturity and stability. It's management's way of saying, we're done with the hyper-growth phase, and now we're a reliable cash-generating machine. Getting in on the ground floor when a company first starts paying a dividend can be incredibly lucrative. Not only do you start collecting income, but the announcement itself can attract a whole new class of income-focused investors, which can drive up the stock price. These new kids on the dividend block often have a lot of room to grow their payouts for years to come, putting you on the path to becoming one of those early, happy investors. Finally, let's broaden our horizons and talk about venturing overseas. Many American investors have a home country bias, meaning they mostly invest in U.S. companies, and while the U.S. market is fantastic, you could be missing out on some incredible dividend opportunities around the world. Many international companies, particularly in Europe and parts of Asia, have a strong culture of paying dividends, sometimes at higher yields than their U.S. counterparts. Investing internationally adds a layer of diversification to your portfolio. If the U.S. market is having a slow year, your international holdings might be performing well and vice versa. This helps to smooth out your returns over the long term. Now, you do need to be cautious. Investing overseas comes with its own set of risks, like currency fluctuations. A strong dollar can reduce the value of your foreign dividends, and different political and economic environments. But you don't have to become an expert on global markets overnight. You can easily get exposure through international dividend ETFs or mutual funds. These funds do the heavy lifting for you, investing in a diversified basket of dividend-paying companies from around the globe. It's a great way to tap into global growth and income without having to pick individual foreign stocks yourself. So, to recap our strategy for smart dividend investing. First, look beyond the high-yield traps and prioritize sustainability. Second, make dividend growers the core of your portfolio for that compounding magic. Third, look for comeback stories in companies restoring their dividends. Fourth, keep an eye out for newly mature companies initiating their first payouts. And fifth, don't be afraid to diversify your income stream by looking at international markets. Building a dividend income stream is one of the most effective ways to build passive wealth and achieve financial freedom. It requires patience, research, and a long-term mindset, but the rewards are absolutely worth it. You're not just buying stocks. You're buying pieces of businesses that will pay you to own them for years to come. Thanks so much for watching today. I hope you found this guide helpful on your dividend investing journey. If you got some value out of this video, please hit that like button and consider subscribing for more content on building wealth and investing smarter. Let me know in the comments what your favorite dividend stock is. See you in the next video.
Hey everyone, and welcome back to the channel. Today, we dive in deep into a topic that can seriously boost your financial game, making your money work for you with high-yield savings accounts and certificates of deposit, or CDs. If you've got cash sitting in a regular savings account earning next to nothing, this video is for you. We're going to break down what these accounts are, how they work, and how you can use them to build wealth safely and effectively. Stick around, because by the end of this, you'll have a clear roadmap to start earning more on your savings today. First up, let's talk about high-yield savings accounts, or HYSAs for short. Think of an HYSA as a regular savings account. but on steroids. They pay significantly higher interest rates, often 10, 20, or even 50 times more than the national average for traditional savings accounts. So, how do they do this? Most HYSAs are offered by online banks. Since these banks don't have the overhead costs of physical branches like rent, utilities, and tons of staff, they can pass those savings on to you in the form of better interest rates. The biggest advantage of an HYSA is its flexibility and liquidity. This is your go-to spot for money you might need to access relatively quickly. I'm talking about your emergency fund, which will cover 3 to 6 months of living expenses. It's also perfect for short-term savings goals, like saving for a vacation, a new car, or a down payment on a house you plan to buy in the next year or two. You can deposit and withdraw money whenever you need to, typically without any penalties, which is a huge plus. Now, one key thing to understand about HYSAs is that their interest rates are variable. This means the annual percentage yield, or APY, can go up or down over time. It's usually tied to the federal funds rate set by the Federal Reserve. So when the Fed raises rates to combat inflation, the APY on your HYSA will likely go up to. That's fantastic. But the opposite is also true. The Fed cuts rates, your HYSAS rate will probably fall. It's a trade-off for the flexibility you get. Another powerful feature of HYSAs is the magic of compound interest. Your money doesn't just earn interest on your initial deposit, it earns interest on the interest it's already accumulated. This creates a snowball effect, helping your savings grow faster over time. For the best results, look for an account that compounds interest daily. This means every single day, a tiny bit of interest is added to your balance, and the next day, you earn interest on that slightly larger amount. It might seem small, but it really adds up. When you're shopping for an HYSA, keep an eye on accessibility and fees. The good news is that most online banks offering these accounts have very few fees. You'll often find no monthly maintenance fees and no minimum balance requirements. This makes them incredibly accessible for everyone, whether you're starting with $100 or $10,000. Finally, and this is non-negotiable, make sure the bank is FDIC. The Federal Deposit Insurance Corporation protects your deposits up to $250,000 per depositor, PRE, institution. This means your money is safe, even if the bank were to fail. Alright, now let's shift gears and talk about certificates of deposit, or CDs. If HYSs are all about flexibility, CDs are about commitment and guarantees. When you open a CD, you agree to lock up a specific amount of money for a set period of time, known as the term. These terms can range from as short as a few months to as long as 5 or even 10 years. In exchange for that commitment, the bank gives you a fixed interest rate for the entire term. This is the main draw of a CD. Predictable, guaranteed returns. Unlike an IGA Y SCA, the rate on your CD won't change, no matter what happens in the market or with the Federal Reserve. This is a huge advantage if you believe interest rates are about to fall. You can lock in today's high rate and enjoy it for the entire term of your CD, while rates on HYSs might be dropping. Generally, the longer the CD term, the higher the interest rate you'll get. A 5-year CD will almost always offer a better rate than a 1-year CD from the same bank. This is the bank's way of rewarding you for letting them use your money for a longer period. This makes CDs an excellent tool for savings goals with a clear, fixed timeline where you know you won't need the cash. For example, if your child is starting college in 3 years, or you're planning a wedding in 2 years, a CD can be a perfect fit. But here's the catch with CDs. That lack of liquidity, your money's locked in until the CD's maturity date. If you need to withdraw your funds early, you'll almost certainly face a penalty. This penalty is usually a portion of the interest you've earned, maybe 3 or 6 months worth. While this sounds like a drawback, it can actually be a benefit for some people. It creates a powerful saving discipline. You'll be much less likely to dip into your savings for an impulsive purchase if you know it is going to cost you. Another difference is that with a CD, you typically make a single lump sum deposit when you open it. You can't add more money to it along the way like you can with a savings account. So you'll need to have the funds ready to go up front, just like with HYSAs. Always make sure your CD is at an FDIC insured institution to keep your principal investments safe. Now, what if you like the high guaranteed rates of CDs, but you're nervous about locking up all your money for years? There's a clever strategy for that, and it's called CD Lab. Instead of putting one big lump sum into a single long-term CD, you divide your money and open multiple CDs with staggered maturity dates. For instance, if you have $5,000, You could put 1,000 into a 1-year CD, 1,000 into a 2-year, 1,000 into a 3-year, and so on, up to a 5-year CD. Here's where it gets smart. After the first year, your 1-year CD matures. You can now take that money plus the interest and reinvest it into a new 5-year CD, which will likely have the highest rate available. The next year, your original 2-year CD matures, and you do the same thing. After a few years, you'll have a ladder where one of your CDs is maturing every single year. This gives you regular access to a portion of your money while keeping the rest invested at those higher long-term rates. It's a brilliant way to get the best of both worlds, higher returns and periodic liquidity. So, the big question is, which one is right for you? The truth is, for most people, the best answer isn't either or. It's both. A hybrid strategy is often the most effective way to manage your savings. Here's how you can think about it. Use a high-yield savings account for your most liquid savings needs. This is the perfect home for your emergency fund. You need that money to be accessible at a moment's notice for unexpected events, like a medical bill or a car repair. An HISA is also great for those short-term goals where the timing might be a little fuzzy. Maybe you're re-saving for a down payment, but are you unsure if you LL buy a house in 1 year or 3? The HISA gives you the flexibility to act when the time is right. Then, use CDs for your medium to long-term goals where the timeline is more concrete and you can afford to lock up the money. If you know you'll need a specific amount for a wedding in 24 months, a 2-year CD is perfect. You'll likely get a higher guaranteed return than you would in an HISA, and you won't be tempted to spend the money beforehand. The fixed rate gives you peace of mind and makes it easy to calculate exactly how much you will have when the CD matures. Ultimately, whether you're opening an HISA, a CD, or building a CD ladder, the process starts with a little bit of homework. Always shop around and compare rates from different banks and credit unions. Don't just look at one or two. A quick online search can reveal a wide range of Also, read the fine print. Understand all the potential fees, any minimum deposit or balance requirements, and the specific penalties for early withdrawal in CDs. And as I've said before, always confirm that the institution is By using HYSAs and CDs strategically, you can stop leaving money on the table and start making your savings work much harder for you. It's a simple, low-risk way to accelerate your journey toward your financial goals. That's a wrap for today. I hope this breakdown helps you feel more confident about choosing the right savings tools. If you found this video helpful, do me a favor and hit that like button and subscribe for more content on making your money grow. Let me know in the comments which you prefer, HYSs or CDs, or if you're using a combination of both. Thanks for watching, and I'll see you in the next video.